Welcome to the 3-Edge Week in Review for the week of December 16th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. This week, Steve and I will be discussing a topic that has received a good deal of attention on Wall Street, and it's this idea of American exceptionalism. And we'll discuss what investors and the folks on Wall Street mean by when they refer to American exceptionalism and what it could mean for markets in 2025 and beyond. Before we get to today's topic, a look back during the past week. On Wednesday, as expected, the Federal Reserve lowered short-term interest rates by 0.25%. However, on Wall Street, the move was seen as what is referred to as a hawkish cut, and that's because though the Fed did cut interest rates yet again, the summary of economic projections that is part and parcel of the Fed meeting showed that the Fed had reduced by half the number of rate cuts it now anticipated in 2025. The change to the Fed's forecast was based on increased GDP forecast in 2025, along with its outlook for unemployment and inflation. The Fed's hawkish tone was also reinforced by Jay Powell at his news conference when he stated that Wednesday's cut in interest rates was a close call. So, investors did get their much-anticipated cut in interest rates, but the tone from the Fed meant that investors have to adjust their outlook for rate cuts in 2025. So let me bring Steve in here with that backdrop. And so, Steve, recently, as I mentioned, we've seen this in the financial press. There's been this talk about and discussions about American exceptionalism and that concept, and in particular around the strength of the American economy. So maybe you could just begin by describing, what are these people talking about? What is meant by this description of American exceptionalism, at least on Wall Street?
Well, the basic idea is that the U.S. is a unique country with a distinct ideology conducive to success. And there's evidence. Companies based in the U.S. dominate the world in innovation and growth and profitability. And it's quite amazing that while the U.S. represents roughly 5% of the world's population, the U.S. stock market represents close to 70% of the global market equity index value, which is quite astonishing. Also, since the global financial crisis of 2008, the U.S. stock market has outperformed the rest of the world to an unusual degree, and that's certainly captured a lot of people's thoughts and imagination about American exceptionalism.
All right. So now let's discuss another aspect of this, though, which is also getting a good deal of attention in the financial press, and that is the idea that perhaps we are actually at or near what might be referred to as peak American exceptionalism. So what do they mean when they talk about that? What are the implications? And what, in fact, are the risks if we, in fact, are at or near peak American exceptionalism?
So I think that's good you bring that up, because the idea is, perhaps all this is more than reflected already in the outperformance of the U.S. stock market. Now, some people, when they talk about peak American exceptionalism, they use an example like the top 2 companies in the U.S. today are worth more than the entire UK stock market. That's quite extraordinary. There was an example in Japan in the late 1980s where people talked about Japan exceptionalism, and everyone was writing books about the Japanese superior way that they manufacture products, and consultants were going to study in Japan to bring those practices back to the U.S., et cetera. And in Japan, in 1989, a sign of perhaps peak exceptionalism was that the real estate under the Imperial Palace, which was less than one half of a square mile, was worth more than all the real estate in California, which represents over 160,000 square miles. Now we turn that around to the U.S., and right now we have the highest price to sales ratio, our stock market does, in history. It's higher than it was back before the Great Depression, the crash of 29. It's higher than it was before the tech stock bubble burst. And none of the other countries have a price sales ratio anywhere near us, with maybe one or two exceptions, but certainly not as high as 3.2, which is more than double the long-term average. So there are discussions that we are in a bubble. It is reminiscent of other bubbles in the past. And when you're in a bubble, people say, well, this is a new technology. Now it's AI. Before it was internet. Before that, it was communications. Before that, it was railroads. And people say, we're in a new era. The old rules don't apply. But in all cases, we had animal spirits and the fear of missing out that drove the bubble up more than fundamentals of logic would suggest. And in every case, we've had a spectacular rise in the stock market, followed by a spectacular fall, but only after a catalyst emerge.
All right. So my third question, as always, based on what we've discussed here today about the current mood on Wall Street around American exceptionalism and potential that we're at or close to peak American exceptionalism, should investors consider adjusting their own investment portfolios at this point?
Well, I've been reading how investors as a group are as bullish as they've ever been in recorded history by some metrics. There are a lot of people who are more aggressively invested than ever before. And so we just want to throw a word of caution that trees don't grow to the sky. Bull markets don't last forever. And I wanted to show some quotes that I've always enjoyed referring to times like these. One is by the famous investor Warren Buffett. Be greedy when others are fearful, and be fearful when others are greedy. And that might apply now, where a lot of the metrics are showing that as a crowd behavior, as a group of investors, we're way high up on the greedy scale. His professor was Benjamin Graham, and he once said the intelligent investor buys from the pessimist and sells to the optimist. And finally, we have that great organization called the Grateful Dead. And one of their lines was, when life looks like Easy Street, there is danger at your door. So I think all these are relevant. Now, we know that bubbles continue until there's a catalyst. There's no time limit on them. But at 3Edge, we have a set of warning signs, early warning signs that we're looking at very closely to help us make sure that we can get defensive when appropriate on behalf of our clients. And so one is change in Fed policy. Often there are big changes in market direction when the Fed changes policy. And on Wednesday, they came out with an announcement that was reminiscent of some of the announcement they made in the past that changed or created a turning point in the market. So we have to take that seriously. Second, change in investor behavior. Investor behavior has been incredibly strong and bullish for a long time, but we know from history that investor behavior can change on a dime. Next, change in credit spreads. Right now, we're near record low credit spreads, which means that low quality companies pay very little extra interest to borrow money than the highest organizations like governments. And we know that there are some measures of investor complacency around these credit spreads and around lower quality debt that are at very extreme levels. So watch out. We're watching credit spreads. If they widen, that's an early warning indicator. If geopolitical conflict results in an oil price spike, if bombs go off in Iran or they close the Straits of Hormuz, oil price spikes have often preceded recessions and often happen when people least expected it. The return of the bond vigilantes. When governments get more and more in debt, we're seeing this happening in Brazil in real time. The bond vigilantes, which are the bond investors that want to create discipline, say, look, if you want us to keep lending to you U.S. government money, we're going to demand higher and higher interest rates. And even since the Fed announcement on Wednesday, we've seen those 10-year interest rates climb sharply. Next, the prospect of a tariff or trade war. We know that there's a lot of talk about raising tariffs and all the benefits from that. But history also shows that when one country unilaterally raises tariffs, other countries often retaliate, and then it's a lose-lose game. So we have to be worried about that. Finally, If and when the Japanese central bank decides to start raising their interest rates to normal, that could cause the yen to go from deeply undervalued back to fairly valued. And that would cause an unwinding of all the yen carry trades where investors have borrowed money cheaply in Japan and used it to buy U.S. stocks and other stocks. And if that were to unwind, that would cause some selling pressure. And then last but not least, the black swan, which is by definition an unpredictable event that comes out of the blue that can hurt a stock market.
Excellent. So that's a healthy list of things to be careful and cautious of here as we head into the end of 2024 and look to turn the calendar into next year. So thank you, Steve. And that will do it for Steve and me for this week. So this will be our last 3 Edge Weekly video for 2024. And, we're very grateful for the overwhelmingly positive response we've received on our weekly videos. Our goal has always been to speak plainly and clearly about topics of interest to try to help clients and listeners just to better understand the comings and goings on Wall Street because, if we can be better informed and more knowledgeable, we can make better long-term investment decisions. So until next time, which will now be January of 2025, on behalf of Steve here at Week in Review and Eric Beagleisen from View from the Edge, and on behalf of everyone here at 3 Edge, we wish you a happy, peaceful, and safe holiday season with family and friends, and all the very best in the coming new year. And of course, as always, thanks for listening. We'll see you in 2025.